Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we have with us Jay Rhame, co-portfolio manager of the Reaves Utilities ETF. In today's podcast, we talk about the utilities market, what's next for yield-sensitive securities, and some key points on what is ahead for this often overlooked but important sector. So make sure to stay tuned for that right after this. Jay, thanks for joining us. So today we're going to be talking about utilities, and really the first question has to be, what is going on in this space right now? We've seen a great start to the year, but the second half, not so much. What gives?
Well, first, thanks for having me on the podcast. But secondly, I think it's really been a tale of two interest rate environments. If you think back to the end of 2015, a lot of concern that the Federal Reserve was going to raise rates. Well, they did raise rates, and a lot of concerns that interest rates are going to go up. And really in the last half of 2015, utilities performed pretty poorly. And as we moved into the first half of the year, economic numbers were a little bit worse. Concerns about Federal Reserve increasing rates subsided a little bit, and utilities recovered a lot of their underperformance previously. And then, obviously, since the election, we've had about a 4-day, 50 basis point move in the 10-year Treasury, something like 1.8 to 1.3, maybe 50 basis points. And we've seen some of that outperformance come down. It's, utilities, even though they're not quite as interest rate sensitive as people think, certainly the business itself isn't that interest rate sensitive. They certainly do trade as bond proxies. Certainly people buy them for yield, and there's quick reactions to interest rate moves. So I think that's been one of the primary drivers over the past year.
Yeah, and you mentioned the election. Is there anything utilities investors need to consider given the new administration coming into the market? Obviously, Trump has had a big impact on a number of sectors, but can the same be said about utilities, or is this really just a pure interest rate play?
Well, yeah, I think one of the big, if we go back for a second, if Clinton was elected, I think a lot of people felt the prospects for a clean power plan were pretty strong. And now with Trump, I think clean power plan, or at least some kind of federal climate change policy, is probably off the table. And so actually having a climate change policy would have been good for utilities. Essentially any type of regulation that requires companies to spend more money is good for them because they're fully regulated. They earn a return on the amount of invested capital. So requiring more investment equals more earnings for these guys. Now, I think without a federal policy, it's really important to concentrate on the companies that have state-specific policies. Something like California has a requirement to bring renewable energy to 50% of their total electricity use by 2030. And that's independent of whatever else goes on with coal and federal policy. And so the companies in California really have some kind of long-term growth outlook, whereas other companies without that same kind of state support don't necessarily. And so besides interest rates, really the impact on climate change, greenhouse gases, and some states are going to try and counteract that. Some states are going to be more laissez-faire, and I think that we'll see pretty big differences in growth rates in companies over the next 5 to 10 years, really, because of that.
Yeah, that's definitely something I think a lot of investors probably didn't consider when Trump was elected, especially as it impacts this market. But sort of going back to the interest rates, what if this whole interest rate cycle continues into 2017 and we do see more hikes from the Fed? Do you think we're going to see similar choppiness from the utility space, or do you kind of think we're going to see a bit of a pause here now that rates have jumped up so significantly over the last couple of weeks?
Yeah, well, it really depends. Jump is a good word. I personally think it's the speed at which interest rates move which cause the most volatility in utilities. And, really it was a 4-day long interest rate move post the election. And essentially there's been a little volatility, but we've been interest rates have been flat since then, and we've seen utilities, probably rightly so, sell off during the first couple of days after the election, but slowly recover since then. And so hypothetically, if interest rates were to continue to rise over the next year, speed is really one of the big issues. Second, there isn't necessarily a connection between utility prices and the interest rate. I think it's a combination of those two things: utility prices and interest rates, utility yields and interest rates, and also what's going on in the stock market. Because I think it's actually the relative valuation between utilities and the rest of the, say, S&P 500 that matters. Whereas at, say, a 1% 10-year, 1.5% 10-year interest rate, utilities can trade at a premium to the market, but at a 6% interest rate, utilities probably trade at a 10 to 20% discount to the market. And so if the market keeps on rallying, I think that drags up utilities with it, despite perhaps an interest rate increase. So it's a multivariable thing, not just purely interest rates.
Okay. And let's switch gears for a bit and talk about your company's fund, the Reaves Utilities ETF, the symbol UTES. So this is an active ETF, and it's actually the only active fund in the ETF world targeting the utilities market. I find that pretty interesting, especially because utilities is a pretty small sector. So why employ an active management strategy in this relatively small market segment?
We've always been believers that outperformance is really hard, but if you really concentrate in a niche area, your expertise can lead to outperformance. And so our firm was founded in 1961, and all we've ever done over that time period is invest in energy and utility companies. And we've been long only, equity only, and really the fact that we've survived this long shows we've done it pretty successfully. So why the ETF? Well, it's really because we've had this expertise, but it's mostly been available to pension funds, institutional accounts, stuff like that. We wanted to try to create a product that was easily accessible to everyone, that anyone with a brokerage account can go and buy and sell at any time during the day, get it at a low cost, get it in a tax-efficient manner. And most importantly, I think we're fully transparent. And personally, to me, I thought that was really important, that investors know every stock we own every day. We post the holdings on a nightly basis. They know we're not messing around with options or futures or leverage or anything to boost returns. Really, we're just investing in companies that we think can pay a nice dividend, can grow that dividend consistently over time, and ultimately provide a pretty compelling total return opportunity.
Yeah, maybe you can talk a little bit more about some of the criteria factors for inclusion in the ETF.
Utilities are interesting, and if you think back to the interest rate question, a lot of people certainly come in and buy utilities for yield. What that does, though, is, maybe I'll step back for a second, utilities across the country have wildly different growth rates. We talked a little bit about California and having this policy to get to 50% renewable energy. Well, that's going to cause a lot of growth, and a few of the companies have talked about being able to grow earnings, something in the 6, 7, 8% range out in California. Whereas in other parts of the country, where you don't have the population growth, you don't have any regulatory drivers because there's no climate change policy or anything like that, growth is probably closer to 2 to 3%. What happens, though, is because people come in and they buy for yield, typically the ones that are growing 2 to 3% yield a little bit more, but are artificially overpriced because there's really only one criteria, yield. Whereas the California ones or other companies that have higher growth rates pay a lower yield because they're retaining more of that capital and reinvesting it, and are shunned by investors. So in a way, what we essentially try to do is we think we have the ability to buy growth pretty cheap relative to yield in the sector. So our main criteria is really does a company have the ability to grow sustainably over a number of years? And I think that really depends on a lot of different things. But first and foremost, it's regulatory policy. Every state in the country regulates their utilities, and they all regulate it differently. There's different rates of returns. There's different rules for buying and selling power, and it takes a long time to really dive into the details, read a lot of regulatory filings, meet with a lot of the people making those decisions, and trying to determine all that. But so growth is the first one. The ability to increase the dividend over time is very important to us as well. I think that's the main differentiator, and perhaps what people miss when they buy a utility as a bond proxy is that utilities can raise the dividend, and that increase is going to offset inflation, probably be a little bit more than inflation, hopefully, and that's where you ultimately get the majority of your total return over a number of years.
Sure. So what sets your product, UTES, apart from some of the other utility funds out there? I saw on some of the company's site that you guys exclude telecoms and energy as
Mm-hmm.
opposed to a number of other utility funds out there. So why is this an important distinction?
Yeah, well, we wanted to make a pure utility fund. And a lot of people underestimate a lot of the risks in many of the other products out there. I think if you were to look at the utilities in the S&P 500 utility index, a lot of them are selling power, and the price of power is one of the most volatile commodities on earth. And it doesn't really jive with the idea that, hey, I'm buying this low risk utility, nothing ever really happens, when in fact it can be hugely volatile. There's a lot of companies with foreign holdings. I don't think people necessarily realize that they're getting some foreign currency exposure when you're buying the index. And there's different demographic growth, different population growth, different demographics, different regulation. I think just judging by the size of the company doesn't really correlate with kind of the total return upside. So I think a lot of the companies that really dominate the index today really grew a lot in the 50s and 60s, and the areas of the country where that population growth was isn't really where it is today. And so the biggest companies, the ones that dominate it, are probably losing customers every year, whereas ones out on the coast, take Portland General, for instance, out in Oregon, they're growing customers at 2.5% a year. And it's just a wildly different opportunity for them as opposed to some of the kind of older, bigger ones.
Okay. And I also saw that some of the other factors you guys look at are technical analysis in respect to timing of entry and exit. Can you talk a little bit more about what that means for your fund and how you guys evaluate companies on this metric?
I would say first and foremost, we're fundamentalists, and that's our main objective. But, I think that on the technical side, often, after all, they're utilities. The business model doesn't really change that much. And they all grow about the same amount every year. And so it's often smart to fade the breakout or the breakdown, if you will. Things don't really change that much. And being a buyer on a breakdown, being a seller on a breakout tends to work pretty well, I believe, in utilities. And so that's really the main way we use technicals, to be honest.
Okay. And last question I want to ask you. So what would you say the big differences are between your fund and, say, the biggest utilities ETF out there, XLU? It sounds like you guys have a lot more growth focused, and you take the state specifics into consideration. But is there anything else besides that investors should be aware of?
Yeah, it's the growth and state-specific stuff. I think also right now we have basically zero power generation exposure. The price of power exposure. There's several companies, especially 3 or so of the top 10 biggest in the XLU, that really generate a substantial portion of their profits just from buying and selling power. And what's been interesting about power is that demand for electricity peaked in 2007. and it's basically been flat to down since then. Yet in the meantime, we've had this huge amount of natural gas discovered. The price to produce electricity is a lot lower, and we've actually added a lot of generation. There's been a ton of wind power, a ton of solar power. Natural gas power plants are getting much more efficient, and that's really caused more supply, prices down, demand hasn't grown, and so we think that's a trend that can continue for a while. So we're still negative on power, especially maybe even including post the election with, coal plants are probably a little less likely to shut down now. Anything that doesn't take power off the market is negative for these companies. So that and growth are the two biggest differences for sure.
Okay, Jay, thanks for joining us. I think this is a great look at a sector that often doesn't really receive as much attention as I think it should. So thanks for coming on.
Thanks for having me.
All right, everyone, that was Jay Rhame, co-portfolio manager of the Reaves Utilities ETF. The ticker symbol for their fund was UTES, and their site is reavesetfs.com. Well, hope you enjoyed this edition of the Dutram Report. Make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. For my thoughts on the ETF world, make sure to go on over to Zacks.com, check out the ETF Investor Service, which includes my top picks and commentary on the markets. Until next time, for Zacks.com, I'm Eric Dutram.